The other one is keeping up with law changes. We all know that our friends in Washington, D.C. never have anything to do. And often the things that they do tend to reach into your pockets and in my pockets and try to take whatever they can. And I'll give you an example. Yesterday, I was talking to a financial advisor and a CPA and a client about retirement accounts. The CPA and the financial advisor were unaware that in December of last year, the government, the Congress passed what's called the Secure Act. The Secure Act had a tremendous impact on what happens when your beneficiaries, not your spouse, but your beneficiaries, your kids, or anyone other than what's called a qualified designated beneficiary, which is basically anyone other than your spouse or a special needs beneficiary, things like that. So, or a minor beneficiary. So in those types of situations, you have to understand those new laws and how do they affect your plan and what things do you need to do to update to address those issues, because it could have a dramatic negative tax implication on your beneficiaries. So it's really, really important. In addition to Congress, sometimes there are court rulings that affect what happens. For example, there was a Supreme Court ruling about 5 or 6 years ago that had to do with the protection of retirement accounts. So today, if one of you were to go and get in a car accident, and we often like to say rear end a school bus full of attorneys' kids, and like worst case known to man, right? But if that were to happen, they couldn't, and they sued you, they couldn't get to your retirement assets because they're protected. It's considered good public policy to protect those assets. It used to be assumed that when your children or your beneficiaries, again, other than your spouse, inherited those retirement assets, that same protection carried on to them. Well, unfortunately, there was a woman in Wisconsin that inherited a $400,000 retirement account from her mother. And 2 years later, her and her husband claimed bankruptcy. Her creditors, their creditors, went after that retirement account to get paid. Their defense was, you can't, it's a retirement account. And unfortunately, that case went all the way to the Supreme Court, and the US Supreme Court said unanimously, which you don't hear unanimous decisions very often, unanimously said that retirement accounts are, once they're inherited, are no longer protected assets. So that begs the question, how do we protect them? What can we do? So it's important to be aware of that. Estate tax law changes. I met with a client yesterday who had their estate plan, or their parents' estate plan was created in the mid to late 90s. The estate tax exemption at the time was $600,000. Today, that exemption is $11.58 million each between, if you're married, between each spouse. So you each get $11.58 million. Well, most of you will look at that and say, oh, well, I'm nowhere near that. I don't have to worry about it. Well, unfortunately, there are some things we have to worry about. And so we're going to talk more about that. But this is just an example of some of the law changes that have happened. And even if you look, there's several recently, and these are major, major changes. We talked about the Secure Act. There is a benefit for starting to take your required minimum distribution, but to be perfectly honest with you, the major thrust of that legislation was to force out the instead of your beneficiaries being able to stretch your retirement account over their life expectancy, which used to be the law, now they're forced to take that out over 10 years. And when they take that out over 10 years, it increases the size of those required minimum distributions, and then therefore increasing the taxes that your kids have to pay. So again, something very, very important to be aware of as you're talking about your plan and the taxes that your kids are going to pay. That is an income tax issue. So again, I just want to point out, I'm going through a lot here. If you guys have questions or anything like that, feel free to click the button to raise your hand, to type anything into the Q&A or the comment section. I'm happy to address those questions. So feel free. I want this to be helpful. Sometimes estate plans aren't reflected for life's changes. I have a client right now who adopted a grandchild because of a situation with their kids. Well, that changed their estate plan. And so they had to come in, and now when you adopt someone, legally they are considered your blood child. So they are a direct heir. So it's important when you have different situations, maybe it's a new grandchild, or you have a son or a daughter that gets married and they change their last name or divorced or whatever the case may be. It's just good practice and best practice to make sure that your plan is updated to whatever the situation is with your family, okay? This is very often, and that is when you get a change in your assets. Change in assets may be you just bought a new house. Or it may be that you've switched from one financial advisor to another financial advisor. It's important when those events occur that those assets are still properly titled correctly in your trust, or that the beneficiaries are identified properly, depending on the type of asset that it is. So it's always important to make sure that your trust is appropriately funded. It's very, very common for someone to come in and meet with one of us at the office, and they'll show us their trust, and we'll ask what is in the trust, and the response is nothing. Well, I just want to ask you the question, how valuable do you think a trust is that doesn't have anything in it? The answer is it's worth about the paper it's written on. So that's really important. We try to have people come in and meet with us at least every 3 years to make sure that their trust is current, no changes on their side, that the assets are all still funded properly, just to make sure that things go smoothly.